Welcome to Mrs. Moneybags Live. This episode is sponsored by quickequity.ca, getting you to your money fast by providing clients with customized mortgage solutions to clients all over Canada. I am your host, Nicole Williams, aka Mrs. Moneybags, mortgage agent level 2. We go live Monday to Friday, keeping you posted on the latest financial developments, market trends, and economic news, helping our viewers make informed decisions about their money. Reminder to do your own research. Our content is intended to be used for informational purposes only. Let's get into it. So today is Friday. We made it through the week. How exciting is that? So let's get into today's mortgage industry headlines. So here is your summary of mortgage and housing news from across Canada for Friday, January the 12th, 2024. Let's get right into it. So yesterday we had a lot of grid feedback on our socials related to the financial tip of the day. So we'll discuss that, which is the emergency funds. And clients were saying, is there a difference in actually saving for your emergency funds versus having access to credit? So very good topic. We'll touch on that a little bit later. But for now, let's get into the mortgage and housing news from across Canada for Friday, January the 12th, 2024. So despite easing rates, bank CEOs say clients will face $400 to $500 in an increase in their monthly payment at renewal. Okay, so let's get into this article. Despite easing rates, bank CEOs say clients face $400 to $500 monthly mortgage payment hikes at renewal. An anticipated decline in interest rates over the course of 2024 should help soften the impact of mortgage renewal payment shock, according to RBC President and CEO Dave McKay. But he and fellow big bank CEOs estimate that clients are still likely to face a monthly payment hike of between $400 and $500 this year. Speaking at the annual RBC Capital Markets 2024 Canadian Bank CEO Conference held in Toronto, McKay also said falling interest rates should also result in a shallower recession and a faster economic recovery. I think that lower rates are going to help on the credit side. They're going to alleviate some of the payment shock we're seeing in our economy, going to free up more cash flow for consumers to spend in the economy and help drive a quicker recovery and a shallower recession. More like a softer landing, he said. TD Bank President and CEO Bharat Masrani echoed those thoughts. One of the things that we're certainly encouraging now and encountering now is a far, far lower level of concern with these mortgage renewals that are coming up, since the forward curve is implying that the rates are going to go down, he said. Analysts estimate about $251 billion in mortgages are due to come up for renewal this year, with another $352 billion worth in 2025. At RBC, the country's largest mortgage lender, at about 14% of its overall $300 billion mortgage portfolio, will be up for renewal in 2024, with another 25% in 2025 and more than 30% of the portfolio in 2026. It's still back-ended to 2025 and 2026, and we fully expect that rates will come down significantly by 2025 and 2026, McKay noted. Economists from the big banks expect the Bank of Canada to reduce the overnight target rate by anywhere from 1 to 1.75% points from its current level of 5%. That would lower mortgage rates for variable rate mortgage holders. Meanwhile, fixed mortgage rates have also been trending lower since October, which has eased the qualification hurdle for new mortgage borrowers and soften the payment shock for existing borrowers facing renewals. Mortgage holders to see an average monthly increase of about $400. But even with an easing of rates, nearly all mortgage holders are still facing substantial monthly payment increases at renewal, given that most obtained their current mortgages at rock bottom rates during the course of the pandemic. McKay estimates borrowers will experience a roughly $400 a month increase in mortgage payments in 2024, or an increase of about 20 to 25%. That's not dissimilar to what a number of mortgage holders were going through in 2023, he added. And our experience in 2023 as an industry and at RBC is that consumers are doing a very good job of using their savings and changing their spending habits if necessary. Scotiabank President and CEO Scott Thompson said his clients are seeing monthly increases of between $400 and $500 a month, but so far hasn't seen any significant credit issues. McKay also noted that average incomes have risen about 20% since 2019, which is also expected to help borrowers absorb the increase in mortgage payments. So income is up, they've built up a bit of cash surplus, and they have the ability to change their spending patterns if necessary, McKay said. They're handling that $400 increase very well for all three of those reasons. So very, very interesting to note that pretty much the sentiment across the board for all of the major lenders is that monthly payments, despite interest rates coming down, will still increase by, on average, $400 to $500. And this is simply because the rates in which a mortgage renewal holders are coming off of are coming from the rock bottoms, as we heard during the pandemic. So even though rates are down, they are down, they started coming down around October of 2023. But because we had such a high increase between 2022, the ending of 2022 and 2023, this is why, although despite rates coming down, mortgage holders will see on average an increase in their payments. The great news that I'm hearing from all of these lenders is that because there has been an increase in overall income, there's been a surplus. I guess individuals were using this time the past couple of years to bolster their savings. There is savings for clients to tap into. They do have increased payments, and then they're choosing to just become wiser with their discretionary spending. So for the most part, it appears that our economy, although, yes, we will be spending more on housing cost, it appears as though for the vast majority of mortgage holders, they are able to actually maintain, which is a great thing. Okay, so let's get into another article. So Canadian homeowners face large increases to property taxes. So really, we're going to be seeing increases in every single level. It's just what it is. We have seen inflation at numbers we haven't seen inflation at in a while. And it is going to take a little bit of time for our economy to become used to these changes. So as a result, we're seeing it on the forefront when it comes to property taxes, right? So this is it. Canadian homeowners face large increases to property taxes. As Toronto homeowners brace for one of the largest property tax hikes in recent memory, many other cities are grappling with similar issues. Several major cities have approved or proposed major property tax hikes this year as municipalities struggle with inflation, high interest rates, crumbling infrastructure, and soaring demand for services. In Montreal, property taxes are set to rise nearly 5% this year, the largest hike in 13 years. In Vancouver, property taxes are 7.5%, following a 10.7% increase last year. While Halifax is set to see a nearly 10% increase, I did not create this financial mess, Toronto Mayor Olivia Chow, referring to the city's $1.8 billion budget shortfall, but it needs to be fixed. Toronto's budget includes a 10.5% increase in property taxes, which Chow warns could jump to 16.5% if the federal government doesn't chip in $250 million to support the recent influx of refugees. For months, Chow has been calling on Ottawa to kick in more money for refugee claimants who currently make up half of the city's sheltered residents. It's really a challenging time. A professor of planning at the University of Calgary who says all municipalities are feeling a pinch. But she adds, there seems to be little sympathy for property owners in big cities like Toronto and Vancouver, where home ownership is increasingly unattainable for so many. Property taxes are increasing in line with exponential gains in the housing price, she says. This is a robust accumulation of equity, and there comes a time when you have to return something back to the city. But at a time of rising mortgage rates, inflation, and high living costs, adding another increase is a challenge for many. We are already paying, as business owners and homeowners, a lot of taxes, says Helen Reese, who owns a flower shop in Toronto's West End. They, speaking of taxes, should decrease instead of increase. For years, City Hall has kept Toronto's property tax at or near the rate of inflation, despite persistent warnings from staff of a growing budget deficit. If approved, Toronto's property taxes would still be comparatively lower than many other municipalities. Still, a nearly 17% increase is a tough pill for many homeowners to swallow. And while Chow maintains it's necessary to hike to fix problems she didn't cause, CTV political commentator Scott Reed says she'll be blamed for this. The bottom line is the mayor is saying this is the only option. I don't think voters are going to blame Justin Trudeau or Doug Ford or Rob Ford or John Tory or anybody except the person responsible for hiking their taxes, and that's Olivia Chow. Reed says it would have been wiser politically for Chow to raise taxes slowly and build pressure on Ottawa to step in and help. With a pending federal election coming, she had leverage on those MPs in the 416 area code, he says. But she made the mistake of thinking she could ask people to pay 16.5% more in tax and blame someone else. For years, Toronto politicians have argued there should be dedicated federal funding for Toronto, which is larger than some provinces but doesn't have the same revenue tools. If Ottawa is going to pitch in to help this budget cycle, Councillor Shelley Carroll said, that funding commitment needs to come by January 26 in order to make it into this year's budget. I am optimistic the federal government will do something, Chow said. So as you see it, all municipalities are grappling with, changes in interest rates because, again, they too borrow. So as interest rates go up, so does their cost of borrowing. And then inflation, it doesn't just affect individuals, it does affect businesses, it affects municipalities, it affects governments, it affects everybody across the board. So the challenge is how do we raise these funds that are being presented within the budget, the deficit that is being presented within the budget, and allow all stakeholders to feel as though you're not trampling on them, in this time. Definitely, it is something that we are going to be watching. As a resident of the Greater Toronto Area, this is something specific that I will be interested in seeing. So regardless, the City of Toronto will be having an increase. The goal according to Olivia Chow, is that it would be a 10.7% increase rather than 16.5%. But the 16.5 is very, very, very possible if they do not get the federal help they are looking for. So there you have it across the board. So we see interest rates have risen, and as a result, lenders are predicting that mortgage cost for clients whose mortgages are coming up for renewal will also increase anywhere between $400 and $500 a month. And then when we look at municipalities who are on average increasing taxes anywhere between 7% and it looks about that 10% mark, that too will have an adverse effect upon individuals' monthly budgets. What are your thoughts on this? Drop your comments below. Let's get talking. What are your thoughts about the predicted $400 to $500 monthly increase in mortgage payments? And also, what are your thoughts about most municipalities looking to increase property taxes in order to help alleviate their budget deficits? What are your thoughts? Let us know in the comments below. Okay, so today we're going to review just the two articles because I wanted to spend a little bit of time answering some of the comments that we received related to the financial tip from yesterday. So on socials, we had a great comment, and I'm going to pull it up so we can read it together. And again, if you recall, the financial tip yesterday was to save 3 to 6 months worth of living expenses in your emergency fund. Okay. So with that being said, the question came in saying, I really do not and kind of living month to month. So the person said they're living month to month, but they maintain an extreme or an excellent credit score, which enables them to borrow from banks if needed. And does that count? So my response on the socials was that it isn't uncommon. A lot of individuals, as a part of their financial plan, do include some form of credit as a means when it comes time for emergencies. So a classic example is establishing a line of credit. The good thing about a line of credit is that you are not charged interest when you do not owe anything. But it does act as a reserve fund for when you do. So if you have a line of credit established, let's say that's $20,000, and it's sitting there and you don't owe anything, you're paying nothing to have that line of credit in most instances. However, in an event of an emergency, yes, it is correct, you could tap into that $20,000. So it has been a strategy for some clients for some years to establish some forms of credit products such as that to help assist them in their times of need. The goal, however, and the financial tip that we established yesterday, which was establishing 3 to 6 months of your expenses, this really is from your own resources. So we're not suggesting, because from this comment, that individual is living a little bit more on the month-to-month basis. So perhaps they don't have as much cash flow available within their budget to allocate towards their emergencies. My recommendation, which will lead me to today's financial tip of the day, is review your budget. Review where your money is being spent and see if you can carve out even as little as $10 per month. Can you carve out $50 per month? Can you carve out $100 per month? And get into the habit of just putting this money aside and build. So yes, it might take some people a month to save 3 to 6 months worth of expenses. For others, it might take a full year. And for others, it might take them even longer. The goal is just to get started. We're not saying this is going to be an overnight thing, but get started. We are building 2024 on the grounds and on the premise of utilizing our resources. So yes, I know everyone always talks about using other people's money and the effects of being able to build wealth by using credit, etc. I am not in disagreement with any of this. All I am saying and all we're suggesting is that we should become in the habit of saving for our emergencies from our own resources. And the reason why I say this is, what if your financial situation doesn't improve immediately? And now you are using this line of credit or this credit facility. And what happens is you just dig yourself deeper and deeper and deeper and deeper into a financial hole. It doesn't mean that because you've dug yourself into a hole that you can't get out. We're just saying let's be proactive. And rather than having to dig as deep as you perhaps would without the savings, at least by having the savings, you have a little bit of a parachute to assist you during those times. I hope that makes sense. But thank you for commenting, and let me know in the comments below, what are your thoughts? And again, there's no right or wrong answer here. If you are most comfortable using credit for emergencies, I am not going to be the person to tell you to do anything differently. We're just trying to establish habits that prepare us for success. Okay. So again, the goal is saving 3 to 6 months worth of expenses in the event of an emergency. So let's get into the Mrs. Moneybags affirmation of the day. Wealth constantly flows into my life. Wealth constantly flows into my life. Let's say that together 3 times. Wealth constantly flows into my life. Wealth constantly flows into my life. Wealth constantly flows into my life. That's all the time we have for today. Thank you for watching Mrs. Moneybags Live, and we'll see you next week.